Okay, so we were discussing today corporate capital structure. Broadly, we are going to discuss bond, equity, dividend policy, leasing, and cost of capital. Before I discuss all this, let me give you the idea what we are going to discuss today. Suppose you are a listed company and you want to get money for the new projects or for your running of day-to-day activities. What options you have with you in terms of money? The traditional way is you go to the bank. Bank will give you, they will take your financials, they will assess you where you stand, that much money they will give you. But you can see in this way also that banks as a procedure, what they do is they take money from the public and give it to the public. It's like a platform for which matches the borrowers and the lenders' need. So if you want to give money to the bank, they will offer you 4%, 5%. You want to take money from the bank, they will offer you 10%, 11%, 12%. So it apparently gives, why to give this benefit of 6% to the bank? Why don't you go to the public direct? This leads to a concept called equity financing. Equity is the owner money, the share capital that you have, and sell your ownership, get the money from the public directly. If bank is giving them 4%, 5%, you give them 7%, 8%, more than the banks, and avoid a cost for you. Don't go in a fixed liability situation. Go in the equity portion. Sell your ownership, get the money out of it. And at the end of the year, when you get the profit, if you get the profit, give them dividend. If you don't get the profit, don't need to give the dividend. This seems more easier in comparison with going to the bank. Either you have sales or not, either your company is doing well or not. Fixed liabilities there, you have to pay the installments every time. So that arises the need of issuing the equity. The other way is you don't want to sell your ownership. You are a big company, you are the shareholder, you are the director, you are running this company 60 years, your family 100 years. So you don't want to sell your ownership. Now what to take, how to take the money? Then same like bank, you take debt financing. Debt financing is you don't sell your equity based on your assets or based on your infrastructure, you issue the long-term bonds. Bond is a contractual agreement to pay a fixed agreed interest rate on a fixed period of time. This is how you again go to the public directly with creating liabilities on your part. So broadly, corporations take loans or get money from the public by two ways. One is equity financing by selling the ownership. It has its own advantages, disadvantages. The other way is equity financing. Debt financing is when you go to the public and you create liabilities on your part. Bank loans also come in debt financing. So today we are going to discuss what are the bonds, equity, dividend policies. What is dividend policy? Dividend is very important signal for the market. Any company who issue dividends, people feel good about the company. If 1 year you don't issue the dividends, shareholder or the investor, they feel bad. Because it's a value of money. They give you money, they need return out of it. Then cost of capital is the issue for the current setup and for the new setup. If we issue the cost, if we issue the capital, what would be the cost? Start from the bonds. Bonds are the principal form of long-term debt financing for corporation and governmental entities. Government also issue the bonds, that is the government-backed bonds in US Treasury, US government-backed bonds are also available. A bond is a formal contractual obligation to pay an amount of money called a par value, maturity amount, face amount, to be the holder of a certain date. This is the definition of the bond. Now, all terms and conditions of the bond you will write in one document that is called as indentures. All of the terms of the agreement are stated in a document or a indenture. It's compulsory in US that you cannot issue bonds if you don't have money. You have to open an account. His name is Bond Sinking Fund. This fund you have to create, you have to put the money so you can pay the regular installment. This is for the security of those guys who are going to carry your bonds. Because in case of defaulter, everything comes on government or through SEC, that is Security Exchange Commission. So these corporate governance things emerge as a need basis. So for a bond, you have to open a bond sinking fund. The objective of making payments into the fund is to segregate and accumulate sufficient assets to pay the bond principal at maturity.
So the equal amount you wanted to deposit?
No, depends upon it. We will see certain types of bonds, but he is talking about the principal amount. Principal amount.
What is the principal amount?
Yes, you bought a bond, you get the interest, and your principal amount is there with the company. Think from company point of view. I sell a bond, you give me a money. For you, it is the principal amount which I kept. Now I have to pay you interest. And after the maturity of the bonds, when the bond term is finished, I have to give you principal or any interest remaining.
Okay.
So as for this sinking fund, I have to keep the principal. I have to keep some funds, so on maturity, I can pay you the principal amount.
Okay, if we issue bond for 100,000, so that 100,000, each 100,000, we want to keep it sinking fund?
No, there is no gain of doing something. If you will issue bonds, say $1 million, and you put all $1 million in this bond sinking fund, so what is the advantage to have the bonds? You need money. Based on certain portion, you have to keep it as security. For example, all these banks, there is some certain reserve is in the central bank.
Okay, just like that only.
Yeah. What is the ratio? That depends upon country to country, regulation to regulation, ratio to ratio. So this is the bond. You have to create a bond sinking fund in which you have to keep the amount.
So that's the funds under lien, is it same?
Fund under liens. Lien is a form of making yourself secure. If you have already secured, you have gold, you have assets, you have some factory with you, with someone give you the documents, you give the money, that is a different thing. That is not a bond. Bond is a procedure where you go to the underwriter will write bond for you, you will float it in the market, then people will give you the money, it should have a maturity date, it should have the stated interest rate. Anything that comes under security, secured loan, this is called secured loan. This bond is unsecured loan, which the government tries to make it secure by creating this bond sinking funds. Now there are some advantages and disadvantages of this. In US, when you issue equity, it is subject to high taxation. But once you take the liability on your part, it is tax exempted, you don't need to worry. So cost of equity financing is always higher than the cost of debt financing. So this is the biggest advantage to issue the bond, that you will save yourself from the taxation effects. Secondly, basic control of the firm is not shared. If you sell the shares, your ownership, because the subsequent influence and the control will not be in your hand, so you might lose the chair of the company. While in debt financing, no issues. You are creating a liability for the company. Owner's structure will remain the same.